Welcome to our halftime report. We're delighted to have you here today and look forward to sharing some current and relevant information with you. We do these twice a year, one at the beginning of the year, one during the middle of the year. I did glance at the attendee list, and I'm happy to see a mix of some familiar names and some names that I'm actually seeing for the very first time. So, welcome everybody. Before we start, please take a few moments to review these disclosures. They're mandatory. So for those of you who are, new to our company name, we are a boutique wealth management planning firm headquartered in downtown Birmingham, Michigan, with other locations in Dearborn, Michigan, Novi, Michigan, and Franklin, Tennessee. So I'll give you a minute or two or a couple moments to take a look at that disclosure, and then we'll move on. Okay, let's get into it. The purpose of the call is to get a better understanding of what happened in the financial markets and the economy in the first half of 2024 and what may unfold in the months ahead. Please, if you have any questions during the presentation, feel free to type them up in the Q&A box on your computer screen, and we can address those at the end of this call. You should find that button at the bottom of your screen, and it should read Q&A, okay? And there's a lot of information here, but if something stands out, please jot it down, and we can address that area. Here's today's agenda. First, we'll review the first half of 2024. Second, we will provide a second half of the year outlook with some potential driving forces. Thirdly, we'll take a look at where we are today. And finally, we'll take a look at what's ahead for the second half of 2024. So let's begin by reviewing how the stock market performed during the first half of 2024. Here's a snapshot of the S&P 500 performance from January 1st, 2024 to May 31st, 2024. The S&P 500 notched a solid gain. As a matter of fact, today, July 16th, the S&P 500 is yet even higher than this chart suggests. The S&P 500 is now at 5,654. Which means the S&P 500 is tacked on an additional, 395 points since May 1st. So the first half of 2024 was marked by three overriding themes. First, AI enthusiasm, or artificial intelligence enthusiasm, which continues to drive such companies as the Magnificent Seven stocks much higher than where they were at the beginning of the year. The Magnificent Seven comprises of NVIDIA, Microsoft, Google, Apple, Meta, Tesla, and Amazon. Second, inflation fears by the consumer, even though there continues to be positive progress in bringing down that inflation number. And thirdly, the Federal Reserve signals towards monetary policy, particularly the potential for the Fed to reduce the Fed fund rate. During the first half, you may have heard the phrase Goldilocks economy, which simply suggests activity was moving forward at a not too hot, not too cold pace. So how does the S&P 500 performance thus far compare to what the expectations were at the beginning of the year? And at the beginning of the calendar year, Wall Street analysts sent out their supported predictions for the year ahead. This image shows several projections shared at the end of 2023 going into 2024. How do those predictions compare to reality thus far? Well, the S&P 500, as I stated a moment ago, sits at 5,650 and is exceeding the group average of 4,817. With that said, there's a whole second half of 2024 to come for the S&P 500. Recently, over the last several weeks, many of the leading Wall Street firms have revised their targets up from these levels that you're looking at. The group average is now 5,300 in comparison to the beginning of the year when the group was targeted at, the group average was at 4,817. So they've upped their projections, but are still, as a group, have an average that's lower than where we are currently with the S&P 500. And remember, predicting the S&P 500 will be, where it will be by the end of the year is challenging, right? No one has that crystal ball, and especially in 2024, given the uncertainties of inflation, global economic growth, and central bank moves around interest rates. In the following slides, we'll discuss the factors that may impact stocks in the second half of the year. And to create some context about where the economy may go in the second half of the year, let's start by looking back a few years ago so we can get a better perspective on how quickly outlooks can change. We picked January 2022 as a reference point, since it represents a moment in which the pandemic was now mostly in the rearview mirror. As these indicators suggest, the outlook for the coming 3 to 6 months was exceptionally optimistic. A lot of green. The Federal Reserve's monetary policy remained accommodative, and interest rates had not yet begun their climb from their historic lows. On virtually every important economic indicator, from inflation and monetary policy to credit availability to energy costs, it was flashing positive. Only 3 indicators were neutral or cautionary: the political environment, equity market valuations, and geopolitical risk. There were no negative indicators. However, these conditions would soon reverse. By January of 2024, just 24 months later, the outlook for the coming 3 to 6 months going forward changed to guarded from optimistic. First, despite interest rate hikes to historic levels during the first half of 2023, by the second half of the year, the Fed had started to slow down the pace of that tightening. As you can see, 17 of the indicators were neutral at the start of the year, while 3 slipped to red, those being equity market valuations, international economic outlook, and again, geopolitical risk. Now let's fast forward and see where we are today. Can you see the difference? Now, roughly 1/3 of these economic and financial indicators are positive, with only 2 negative, that being valuation outlook, and again, geopolitical risk. Q1 earnings season helped boost the corporate profit outlook, and notably, inflation, labor, and credit availability are among the indicators now in green. Consumer spending, consumer sentiment, housing, and inflation also have swung to positive outlooks. All right, here's another chart talking about earnings. This chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share. One of the more widely used ways to get a reading on whether the market is overvalued or undervalued is to look at the price earnings ratio of the S&P 500. The current PE for the S&P 500 is about 27. And at these levels, the S&P 500 looks a little expensive compared to historic levels. The average PE ratio over the last 20 years, about 21. Now, if we look at forward earnings on the S&P 500, the forward PE of the S&P 500 is sitting at 19.9, call it 20, compared to the 10-year forward average of 17.8. So a little overvalued based upon forward earnings. As you can see, the two lines have generally moved in the same direction over the past decade, but because the stock market is a discounting mechanism reflecting what investors believe the economy will look like 6 to 9 months in the future, stock prices can, at times, change more quickly than earnings growth. At the highest level, the Federal Reserve has 3 functions. Number 1, to provide an effective payment system for the U.S. Number 2, to regulate banking operations. And number 3, to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated all along the way that it's comfortable with inflation in the 2% range. The chart we're looking at depicts consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see in the chart to the left, there was an uptick in year-over-year inflation numbers in Q1 2024, which is one reason why the Fed is being cautious about changing the course with interest rates. That Q1 increase was followed by a modest decline in April. But the consumer price index still remains above the Fed's target 2% inflation rate. So expect the Fed's decision or decisions on monetary policy to continue to influence the financial markets throughout the second half of the year. The labor market continues to demonstrate its resilience despite questions about the economy. The strength has provided important support to the markets since having a job is foundational to consumer spending, which helps drive economic growth. This strength may be best illustrated by 2 labor market measures, the unemployment rate and the current job openings. The unemployment rate continues to remain at historically low levels thanks to robust hiring by private sector employers. Even in the face of robust hiring, the percentage of companies unable to fill open positions remains quite elevated, despite falling off somewhat in the last 12 months. By these historic measures, the labor markets appear healthy. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable and it surveys at least 500 residents of the U.S. each month. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product. As the chart indicates, consumer confidence has continued its recovery from historic lows in June of 2022. The chart shows that sentiment has been on a general upswing since that time. Artificial intelligence. has been a market buzzword for the past couple years. And to keep investors updated, Standard & Poor's 500 companies are providing updates as part of their quarterly conference call with their investors. As you can see in the chart, in Q4 2023, AI was mentioned on earnings calls 179 times as investors want to hear from companies about their plans to use the newest technology. Now, let's examine the present before we dive into what the future may hold, okay? Let's take a moment to consider the variables that may weigh heaviest on market performance. We believe the factors that led to the first half market's performance may remain critical to how the market may behave in the second half. The first factor is inflation. While accelerating inflation is no longer a concern of the market, some investors, and perhaps more importantly the Federal Reserve, worry that inflation may prove to be sticky at these elevated levels. If inflation remains where it is presently, then it may influence the Fed's decision on short-term rates. Second factor is that a recession is still a possibility as the economy has shown signs of slowing. However, the U.S. economy has remained resilient, raising hopes for a soft landing. And if the economy slows too much, the Fed has stated it stands ready to cut rates to spur economic activity. The third factor is artificial intelligence continues to be a driver of stock market gains, particularly when companies discuss AI adoption in their operations. Greater efficiencies, focused capital spending, and continued positive consumer sentiment are factors that would push companies to explore AI opportunities. Of course, no one can predict what will happen in the future, but we hope that the following perspectives help you understand what we believe may be on the horizon. And finally, let's look at potential forecasts for the second half of the year. Economic growth may be an integral variable in how the markets perform in the coming quarters. To gain better insight into how economists think the economy will perform, we took a look at the May 2024 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. Let's look specifically at the consumer forecasts for three key economic factors that may drive much of the market's perception about the state of the economy: GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view as of May 2024 is that the gross domestic product is expected to come in between 1.5% to 2.4% in 2025. Meanwhile, these professionals are projecting that the unemployment rate remains low at between 3.7% and 4.2% in 2025. And they expect inflation, as measured by core personal consumption expenditures, to be between 2% and 2.4%. Now remember, forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the forecast. What can we expect for future corporate earnings? If you take a look at the chart, you'll notice that earnings for 6 out of the 11 core industry sectors of the S&P 500 are expected to grow compared with today. Near the center of this chart, you'll see it. It's the overall earnings growth projection for all S&P 500 companies, estimated to be 14.2%. Some sectors are expected to do better, while others projected to lag. This chart was printed on May 2024. Fast forward to June 21st, and we now have 9 of the 11 sectors predicted to report year-over-year earnings growth. Industry analysts in aggregate predict the S&P 500 will report year-over-year earnings growth of 11.3% in 2024 and 14.4% in 2025. If these numbers are the actual earnings growth rates for these years, it will mark the third time in the past 15 years that the S&P 500 has reported 2 consecutive years of double-digit earnings growth. The last 2 times the S&P 500 reported 2 straight years of double-digit earnings growth was 2017, 2018, and 2010, 2011. So, the bar has been raised, and with those raised expectations, we believe does come, more risk of not being able to meet those expectations. Future progress on inflation may be a bit more difficult. The Fed, as well as market analysts and economists, are currently focused in on what they call sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater stickiness with respect to price changes. In this chart, 12-month sticky inflation in the orange line, while 12-month CPI in the gray line. Sticky inflation includes many service-based categories, including medical services, education, personal care services, as well as most of the housing categories. Federal Chair Jerome Powell has often referred to stickiness in service-related inflation as one reason for remaining vigilant in the Fed's fight to lower inflation. As you can see in the chart, while the Atlanta Fed's measure of sticky inflation has been stubborn, it has moderated over the past year or so. Needless to say, the Fed has much to consider as it evaluates monetary policy going forward. So, among the biggest questions investors have heading into the second half of the year are, will the Fed adjust interest rates before the end of the year? And, does the Fed still see inflation as a threat? And if so, what areas of the economy? Now, here's the calendar for the next 4 Federal Reserve Open Market Committee meetings. At the most recent June meeting, the Fed kept the target rate for the Fed fund rate at 5.25% to 5.5%, unchanged. And the median estimate for any interest rate cuts of 0.25 point by the end of the year to just one time. This was reduced from the prior April-May meeting where the estimates showed a possible 3 rate cuts of 0.25 point for the remainder of 2024. Here's another relationship to understand, especially in today's current equity and fixed income markets. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, as they have over the past couple of years, existing bond prices go down. It's not surprising in today's market that investors are questioning the validity of bonds as part of their well-balanced portfolio, especially when they see other categories to their portfolios, such as technology, making them so much money. Remember, bonds are not a growth type investment, but rather an asset category that is used in a well-balanced portfolio to help mitigate risk. Historically, when the stock market decides to correct and possibly enter bear market territory, that is when an investor should be rewarded for staying true to their balanced portfolio approach. We at the Investment Consulting Group remain steadfast to a balanced portfolio, especially for those investors profiled for that type of portfolio mix. Tuning out headline noise while managing your finances is not always easy. I'm sure many of us have felt prey to this along the way. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals, like a company's earnings or economic data. Another approach that we use in our tactical investment strategies is measuring the supply and demand for asset categories, recognizing that something in demand is typically going to deserve higher prices, and something in supply, obviously the opposite. We've gone over a lot today, but I'd like to conclude with a longer-term perspective on the financial markets. Having this perspective, I think, is key when pursuing the financial goals we've set for ourselves. After disappointing 2022, frustrations were high. But since late 2023, stock market prices have been trending higher. This chart shows an analysis of bull and bear markets during the periods from May 26, 1970 to March 28, 2024. Here we see the average bull market last nearly 76 months. On the other hand, the average bear market has run a little over 15 months. As we can see above, the rewards of a growing and innovative economy often go to investors with the discipline to remain invested over a longer period of time. Remember, investing involves risk, and investment decisions should be based on your own goals, time, horizon, and tolerance for risk. The next point I'd like to convey is a cautionary one on the temptation of getting caught up in exciting new investment themes. This chart illustrates such exuberance happens from time to time. As you can see, faddish themes have occurred fairly frequently since the 1970s, when gold rallied higher only to trend lower. These trends can develop in broad markets as well, like Japan and Asia in the late 1980s. And 1990s, or they can form in certain asset sectors such as the internet or biotech companies. The enthusiasm for artificial intelligence, or AI, started in late 2022 and continues to grow today. I want to emphasize it is important that you maintain a long-term investment strategy and not get sidetracked by fads. Does AI offer the potential of meaningful capital growth for investors in the years ahead? It very well may. But there are ways to incorporate AI into your investment strategy that takes into consideration your goals, your time horizon, and your risk tolerance. So we've gone through a lot of information. Let's take a look at any questions that anybody might have. I believe I can go into the webinar chat if I'm not mistaken, and see if we have anything here. Again, if you're welcome to type in any question in that Q&A if you'd like. Another approach to this as well, if you've jotted down any notes, might be to, maybe consider reaching out to me one-on-one with those questions. If you feel more comfortable in that approach, you can reach me by, email. Just send me a note saying that you'd like to catch up with a phone call or a Zoom meeting or a personal meeting. So let's see here. I don't know if I don't see a Q&A section on my screen. I see a chat section, but I'm not sure that's, well, hold on. Oh, here we are. Found it. Sorry. Chris, can you mention, you mentioned at our last meeting that a correction in the markets would be good. Do you still think so? What concerns you? So yes, corrections are healthy, right? I might have also mentioned this, that, considering the run-up of the market since October of last year, I think it would be very constructive for the market for the ensuing months or quarters to move sideways. That's always healthy to digest a move like we've had since October, whether you're talking about, the S&P 500 as a collective market index or just an individual stock like NVIDIA. Nothing goes up forever. So it would be nice to take a rest on some of these company names that have extended way beyond their, moving averages. They don't just continue to notch higher, and I think a rest would be prudent and very healthy for the overall market. So that's what would concern me too, is if we could just keep marching higher and higher and higher, I think we're certainly set up for, a much larger correction than what we would want to take on, normally speaking, right? And again, corrections are healthy. So, anywhere from 10 to 15% correction from current levels. I know it's not fun to deal with at the time, but it does help, reset the market and help it move up on the next leg when that time comes. So hopefully I addressed that question. Another question here. You didn't mention the upcoming US election in your review. Yeah, I mean, obviously it's a big year from a political standpoint. I don't necessarily want to get into the rhetoric that's going on with politics here in the United States. And the reason being is that I do believe that, the market is its own animal. Yes, political events are going to influence the market day to day, but in the end, the market's going to do what it wants to do. And yeah, I do believe that the outcome of the election will have some influence on the financial markets here in the United States when that time comes. I think more importantly, the outcome of the election is important, but I think what might even be yet more important for an investor, from an investor standpoint, is the 2017 tax cuts that were put in place are due to sunset back to what they were pre 2017. And I think, post-election, regardless of the outcome, you would think that you're going to have a lot of tax law that's proposed between now and January 1st, 2026. So that'll be something that we'll pay attention to. We'll communicate with you on that and let you know those particular tax laws that are up for debate and that do get passed, how that will impact, your wealth management plan. So hopefully I addressed that. Hi, Chris, please remind us when the current federal income tax, okay, so it is January 1st, 2026. So not too far off into the future, right? And you really haven't seen a lot of tax law reform based upon the Tax Jobs Act back in 2017. So, as time progresses, we have a shorter window to, get some of those sunset tax laws changed to something more accommodative for whatever tax bracket that's going to affect that individual. What are your thoughts on the pending federal tax situation? So, yeah, I just think that by each day, and maybe they're waiting around for the election to happen before they really start ramping up, tax reform. But I do believe that there are a lot of things that need to be done between now and January 1st, 2026, unless, the government's are going to let everything sunset back to what it was prior to 2017. Which I don't think is the case. I think they're, my personal take on it is I think they're going to go shoot for the higher tax bracket folks, higher earners, to get their revenue, as they have done in the last wave of tax reform. but you know, who knows? So we'll have to stay tuned on that. And yes, we'll have to implement, especially on the estate planning end of things, for those people that are in taxable estates. You know, they're going to have a shorter window of opportunity to you know, accommodate those tax law changes. So we'll try and stay on top of it and communicate with you on anything that is relevant at the time of discussion on tax law change. Let's see if we have any more. No, I mean, looks like that's it. Again, if you want to go ahead and you know, ask me a question that's more on a personal level, by all means, you know how to reach out to me. For those people that are new to me or the company that are on this call, you can see my email address there or the phone number. You're more than welcome to email me or pick up the phone and call that number, ask for myself or Christy Hubner, who's my that works with me, and we could set something up. Thank you very much. I ran overboard a little bit, but thanks for tuning in today, and have a great day, and we'll talk to you soon.